Hello, everyone. Welcome, and thank you for making time for this webinar tonight. My name is Nikki Dykema, and I'm a representative of BC Pension Corporation. I'm greeting you tonight from the traditional territory of the Lekwungen people, known today as the Songhees and Esquimalt First Nations. I will be your moderator for this webinar. Joining me is Senior Pension Instructor Mogus Kabere, who will lead the presentation today. But before we meet Mogus, I'd like to introduce you to Doug Dykens. Doug is a trustee on the Public Service Pension Board of Trustees and a representative of the BCGEU. Welcome, Doug.
Hello, everyone. I'm Doug Dykens. I'm pleased to share with you that the Public Service Pension Plan has a surplus. We know this because the plan undergoes evaluation at least once every 3 years. Think of evaluation like a snapshot in time that assesses the financial stability of the plan. When evaluation determines the plan has a surplus, we on the board use the plan's joint trust agreement to help guide our decisions in the use of that surplus. The joint trust agreement is a document established by the plan partners. The plan partners are the BCGEU and the provincial government. This agreement gives us guidelines on how to manage the plan. The surplus is being used in different ways for different member groups. Regular members and full-time and regular part-time ambulance paramedics are getting a bump to their accrual rate. As correctional employees, you will too. But your plan design is different. You may remember that in 2018, we moved regular members and these paramedics to a flat contribution rate structure. We expected to do the same for correctional employees and preemptively moved you as well. But there were other details to sort out between the plan partners. Those negotiations continued, but ultimately it was decided the best way forward for correctional employees was to return you to a contribution rate structure integrated with the federal government's year's maximum pensionable earnings, or YMPE. Mogus will touch on the YMPE in his presentation shortly. So what is changing? Your contribution rate is moving from a flat rate of 8.35% to one that's tied to the YMPE. Your new contribution rates will be 8.25% for earnings below the YMPE and 8.95% for earnings above the YMPE. Your pension accrual rate will increase from 1.35% to 1.6%. Overall, your lifetime pension accrual rate and bridge benefit accrual rate will go up from 2% to 2.25%. This means you will begin to earn more pension starting on April 1st, 2022. Lastly, you will receive a refund of the additional contributions you made between April 1st, 2018 and March 31st, 2022. Your refund will be approximately 0.35% of pay and will ensure your contribution rate aligns with your accrual rate on a retroactive basis. Your refund will be issued by check and you will receive it by the end of October of 2022. What stays the same are your bridge benefit and your early retirement provisions. Also, your employer's contribution rate to your pension remains higher than your own member contribution rate. The employer pays 1.5% more towards your basic pension benefit and the inflation adjustment account, and also pays 2.56% for your enhanced early retirement benefits. This means starting April 1st, 2022, your employer's contribution rate will be 12.31% up to YMPE and 13.01% over YMPE. Your early retirement provisions are unique to correctional employees. This is a better benefit than what is received by regular members in non-public safety occupations. The other thing we did with the surplus was set aside funds in the plan's rate stabilization account. The purpose of this account is to offset future contribution rate increases. If a future valuation determines the plan needs a contribution rate increase, we on the board will use funds from the rate stabilization account to lessen the impact. We are making these improvements to your pension to help support its value as you build up your service. We know that correctional employees depend on their pensions, and we are doing what we can to ensure the whole public service pension plan remains healthy and sustainable. With that, I'm going to turn things back to Nikki.
Thanks, Doug. I'm pleased to introduce you to Senior Pension Instructor Mogus Gabete.
Okay, good evening, everyone. The title of this webinar is Public Service Pension Improvement for Correction Employees. Today, I'm going to talk about general information about public service pension, the benefits of the public service pension. We're going to look at the formula to calculate your pension. We're going to look at members' benefit statements. Going to go through each sections. Your statement has 5 sections. I'm going to go through that. And we're going to discuss also some pension terms, define some pension terms, because your pension is one of the most significant asset you have, is your pension. So we need to understand the value of our pension and how it fits into our retirement planning. So there are lots of decisions we have to make when we retire. Such as, when can I retire? Which option can I choose? There are so many important decisions. And to make the right decision, we need to engage ourselves with our pension. So one way to engage ourselves would be to attend webinars and go to the website, Public Service Pension. They do have excellent websites, lots of information about the websites. Today while we are here, we're gonna talk about the latest valuation of the plan. Also, I'm gonna briefly talk about part of the surplus, how it is used to improve your pension, which means we are going to discuss how these changes affect you and improve your lifetime pension. Okay, overview of the public service pension benefits. The youngest age you can start collecting pension from public service pension as a correction employee is 50. Civilian regular employees 55. So that means once you are 50 or older, you can retire and start collecting pension from public service pension. How long are you going to collect once you retire? For life. It's a lifetime pension. The benefit of that lifetime pension after you retire is paid once a month. We get paid once a month. When we work, we get paid bi-weekly, but after we retire, by the end of the month. And the nature of that pension you will receive after you retire is guaranteed. That means your pension will be based on the formula, which is predefined. And that formula primarily takes into account 2 major factors, which we're going to talk about later. One is years of pensionable service you have, and the second one is your highest average salary. Again, I will discuss about pensionable service and the salary. These are the 2 elements that will get reported by your employer to the public service pension. As far as the funding is concerned, it is fully funded. That means there are 3 elements that will fund the pension. One is investment income. The other one is employee contribution and employer contributions. These are the 3 elements that fund your pension. Also, if you retire before age 65, between 50 and 64, you get additional pension. On the top of your lifetime pension, you get a bridge benefit. The bridge benefit is added to your lifetime pension. However, bridge is not paid for life. Bridge amount will stop once a retiree turns 65, or if they die before 65, the bridge will stop. In other words, the bridge benefits, it doesn't continue to the surviving spouse or beneficiary. Bridge will die when the person dies. And the bridge amount is also guaranteed, meaning just like a lifetime pension, it's based on the formula. Takes into account years of pensionable service you have, highest average salary, and YMPE, which I will talk about later on. And it's also fully funded, the bridge amount. And there is also inflation adjustment accounts that apply to your pension, meaning during your retirement or once you retire, your monthly pension payment may increase because of annual inflation adjustment. How often? Once a year, every January, to offset the effect of inflation or to catch up with the cost of living adjustment or to keep pace with the increase in the cost of living over time. They can see cost of living adjustment is subject to funding. That's why it says it's not guaranteed. However, once inflation adjustment applied to your pension, it becomes part of your basic lifetime pension. That means they will never take away from you. This year, cost of living, by the way, the inflation adjustment is based on the Canadian Consumer Price Index. And this year was 2.7. So all public service retirees pension increased by 2.7. So what they do is the board members review every year the change in the consumer price indexing over 12 months. They look at the economy factor, how much fund available in the inflation adjustment account, and decide if how much to grant, depending on the availability of the fund. All right. Another benefit will be you can have access to group benefit after you retire, because when you retire, any extended health and dental benefit you've been receiving through your employer will stop. However, once you start collecting pension, you can apply for these benefits, extended care, dental. Then it'll continue through the public service pension. Not only for yourself, you can also include spouse. If you have a spouse and the spouse is not a member of the public service pension, they can have access, or you can include them. Or dependents. If you have a dependent under the age of 19 or they're full-time students under the age of 25, you can include them. And extended care is right now, currently, it is subsidized. Right now, if you have 10 years or more, it's fully subsidized for plan member. Spouse will have access at a group rate, which is still cheaper than if you go privately to another insurance company. Whereas dental is group rate. It's completely voluntary, and both member and spouse will have access at a group rate. And the provider currently for this group benefit is Green Shield Canada, and Green Shield Canada is national. That means if you move to another province in Canada, you'll have access to these group benefits. But if you're planning to travel or to go out of country, they suggest to buy a separate travel insurance. All right. Now, next, we are going to discuss briefly about the plan change that is in effect on April 1st, 2022. We are going to review the 2020 evaluation. We are going to discuss contribution rate change and improved the accrual rates that Doug was talking about, and also explain contribution refunds. And also, finally, we'll discuss about changes to the pension formula that will be in effect on April 1st, 2022. So the 2020 evaluation. Now, every 3 years, as Doug explained, an independent actuary, which are professional with a specialized training in financial modeling, law of probability, risk management, they assess the financial position of the plan, including the adequacy of employer and employee contribution. So the valuation report, they use different actuarial assumptions. They review different reports. They look at different reports such as the plan's assets and the liabilities. They also look at the demography. How many active members do we have? How many retired members do we have? How many active members are we going to have in the future? retired member, look at investment return, economy factor, mortality rate, and then they make a report. And this report helps the board to make a decision on contribution rate, for example, or on plan rules. Of course, to the best interest of the plan members and employers, while making sure that the plan is sustainable as well as equitable to all members. And the recent actuarial evaluation for public service pension was completed as of March 31st, 2020, and it showed that the plan had 109.6% funding ratio. That means the plan was fully funded and in fact had a surplus of 2.7 billion with B. All right. And so again, the board decided to use a part of this surplus to make improvement in the pension plan for correction employees and other public service regular employees. And we're going to look at the formula, the improved formula later on. So one of the change is contribution rate structures. It will change. Prior to August 1st, 2018, the contribution rate structure was integrated or tied with YMPE. YMPE stands for Year's Maximum Pensionable Earnings. This is the maximum salary we contribute into Canada pension. Right now, when you work, you contribute into two pension plans. One is public service pension, which is the provincial pension. The other one is the Canada pension, the federal pension. Public service pension, there is no maximum as far as salary is concerned. The more you make, the more you contribute into the public service pension. Whereas Canada pension, they do have a maximum salary. They have a ceiling. That maximum salary upon which contribution into Canada pension stops is called YMPE. That amount is determined by CPP and it changes every year. Last year, for example, it was 61,600. This year is 64,900. I mean, prior to August 1st, 2018, the contribution rate structure was 7.93% up to YMPE, up to the maximum pensionable earnings. For example, let's say the maximum pensionable earning was 58,400. Then up to that point, contribution was 7.93. Anything over and above, it was 9.43. So it's tied with YMPE, how much you contributed. And effective August 1st, 2018, they moved to a flat rate of 8.35% of your salary, regardless of your income level. But now the plan partner have decided to return contribution rate to the pre-August 1st, 2018 structure that tied contribution to the YMPE. So what does that mean? That means effective April 1st, 2022, employer contribution rate will be 8.25% of your salary up to YMPE and 8.95% of your salary over YMPE. See, back to that structure. And this new rate, will be backdated or retroactive to August 1st, 2018. Because it's going back to August 1st, 2018, that means a couple of things. One, you might notice a difference on your paycheck in the first pay period of April 1st, 2022. Second, all correction employees who made contribution between August 1st, 2018 to March 31st, 2022 will receive refund of over contribution made during this period as a result of the contribution rate structure change. All right, and employer also pay a little more. It's about 1.5% more on the basic and indexed, and 2.56 on enhanced benefit as well. So That means how much you get refunded. You will be refunded 0.35% of your salary, of your overall contribution made between August 1st, 2018 to March 31st, 2022. And the refund will be issued by check after the plan's fiscal year and reporting is complete. And this would be between May and end of October. So by the end of October, you get a refund of this contribution. And the other thing is, as I said, improve pension accrual rates. Doug was talking about higher accrual rates. As I said earlier, your pension is calculated based on the formula. We're going to look at the formula now. And part of that formula is, one is, as I said, pensionable service. There is YMPE. There is your highest average salary. And there is a multiplier. That is what we call the accrual rates. Multiplier of your pensionable service and your highest average salary, or we call it the rate at which you build up your pension benefits. So starting April 1st, 2022, your pension accrual rate will increase from 1.35% to 1.65% on earnings up to the YMPE. And your accrual rate on earning above, over and above YMPE remain the same, which I will show you what I mean by that. It's 2%, it remain 2%, and the bridge benefits or the bridge accrual rate also remain the same. But as of April 1st, 2022, because of the improvement in the formula, the lifetime pension and the bridge benefit rate is now 2.25 instead of 2%. That means you will earn more pension on service earned on or after April 1st, 2022. This will increase, of course, your lifetime pension. Also, the board has set aside $1.1 billion on the valuation surplus for the plans, what we call rate stabilization account, to prepare for the future. That means, for example, if the future valuation determines the plan needs a contribution rate increase, then the board will use the fund from this account to lessen the effect on members and employers. Right now, let's look at the formula, the pension formula. So depending on when you joined the pension plan, or when you earned service, different formulas will be used to calculate your pension. So one is for service earned before April 1st, 2006. Those of you who joined the public service pension prior to 2006, any service you had up to March 31st, 2006, there is one formula. And then, because again in 2017, the plan had a surplus, they improved this formula, they enhanced the formula for service earned between 2006, April 1st, 2006 to March 31st, 2018. For that 12 years, there is enhancement on the formula. And then from April 1st, 2018 to March 31st, I went back to the previous rate. And then starting April 1st, 2022, again, a higher accrual rate. So here it is, the formula for service earned before April 1st, 2006. The lifetime pension is 1.35. If you retire before 65, you get a bridge, it's 0.65. You add that together, it's 2%. Between April 1st, 2006 to March 31st, 2018, because of the surplus they had, according to the 2017 evaluation, they increased the lifetime pension to 1.65, bridge 0.35. You add that together, gives you 2%. Again, from April 1st, 2018 to March 31st, 2022, again, 1.35 is a lifetime pension, 0.65 is a bridge, it's 2%. Starting April 1st, 2022, because of the 2020 evaluation, the lifetime pension went up to 1.6, the bridge remained the same, 0.65. You add up together, it gives you 2.25%. All right. So the accrual rate here, it is the accrual rate where you put the 1.35 or the 1.65. Then your has up to YMPE. As I said, for example, when you retire, they calculate your highest average salary. The highest average salary not necessarily has to be the most recent one, or they don't need to be last 5 years, the best 5 years, wherever they are. They add them up and divide by 5, that will give you your highest average salary. And then they compare that highest average salary with a previous year YMPE, year's maximum pensionable earnings. This year, as I said, the YMPE, which is a maximum salary contributing to Canada pension, is 64,900. Let's say the person is retiring next year, right? So say the highest average salary is more than the YMPE. Let's say 74,900. So what will go, the accrual rate for pre is the lowest amount of your YMP, the YMP or your HAS. Say your HAS is 74,900, the YMP is 64,900, it goes 64,900. So plus 2% times the excess, 10,000. If there is no excess, then there is no 2%. Then years of pensionable service you had. If you are under 65, you get a bridge, and the bridge is the accrual rate times the accrual rate applied depending on which period your service belongs to. Then the lowest amount of the two, has or YMP, and then years of pensionable service you had. After April 1st, 2022, the accrual rate is 1.6. The lowest amount of your has or YMPE, whichever is less. Excess, if there is excess, will go in the 2% times years of pensionable service you have on or after April 1st, 2022. So the new formula, the improved formula, is in a go-forward basis. That's for service earned on or after April 1st, 2022. And then the bridge remained the same, 0.65%. And the lowest amount of your has or YMPE and years of pensionable service you will have on or after April 1st, 2022. And by the way, if you're planning to retire, or if you go online pension estimator, you put retirement date on or after April 1st, 2022, the online pension estimator will factor in all this. Use all these different formulas, different accrual rates as well. One of the element they use to calculate your pension is your highest average salary. And by the way, highest average salary does not include, for example, overtime for most employers. Bonus, they are not pensionable. So they use base salary. And over your work history, they go pick the top 5 years or 60 months. For most people, the last 5 years might be the best 5 years. So in this example, this person last 5 years are the best 5 years, but not necessarily. Had this person earned more salary, one of the highest salary was 2010, 2010 would have been part of these 5 years. And then the years of service, the second element used to calculate your pension. So the years of service must add up to 60 months. Because 5 years, 1 year has 12 months, 12 times 5 equals 60. So this person also here, the public service pension, they use a fiscal year. Fiscal year started April 1st, goes to March 31st. So if someone retire end of March, by the end of the fiscal year, say they have 12 months, they go until that 60 months window is done. That means it takes about exactly 5 years. If they retire by the end of the fiscal year, and then it will be 5 years, you will have 60 months. So And then they calculate your highest average monthly salary. How do they calculate the highest average salary? They divide your pensionable earnings by pensionable service you have that year. And the last column will be your highest average monthly salary. Another example, someone who works part-time. And by the way, working part-time will affect your pensionable service. I'm going to define about pensionable service. You work full-time every month, you get 1 full month of pensionable service. You get full-time the whole year, you get 12 months. If you work half-time, it would be prorated. You get 6 months. So in this case, this person gets 10 months for every year they work part-time. So the salary, again, is lower than the person who've been working full-time. So this person, the full-time person, made 75,000, 12 months pensionable service, 6,250 monthly, highest average monthly salary. Another person exactly doing the same job but working part-time, they made 62,500 because they were part-time. The pensionable service was 10 months. The highest average monthly salary, if you look at it, it's exactly the same, 62,050, same as the one who worked full-time. In other words, when you retire, even if you're part-time, your highest average salary, monthly salary, will be converted into full-time equivalent. Or working part-time does not affect your highest average monthly salary for that year, as long as there is same hourly rate. But what will be affected big time will be your service. Right? If you work half-time, let's say somebody works full-time, they make $60,000, 12 months, 5,000 is the highest average monthly salary. Another person work half-time doing the same job, they make 30,000, the service will be 6 months, it's 5,000. But service will be different. So what will be affected is the service. And even if you're part-time, the years of service again must add up to 60. That means it can span over 6 years to get the 60 months window. It can span over 7 years, but you must add up to 60 months. All right, summary of the plan change, effective April 1st, 2022. Again, contribution rate structure will change, meaning up to YMP, contribute 8.25%, over and above 8.95%. This will go backdating to August 1st, 2018. And the improved pension accrual rate for service earned on or after April 1st, 2022, go up to 1.6%, up to YMP. Anything over and above will be 2%. Because of the rate structure, the contribution rate structure change, and because it will be backdated to August 1st, 2018, you get refund of contribution. We talked about rate stabilization accounts to prepare for the future, to protect a member and employer. Now, we're going to talk about your members' benefit statement that you receive everything. We're going to learn how to read your members' benefit statement that you receive by fall. All right, and your statement has 5 sections. And section number 1 is the top part, your personal information. Your last name, your first name, your date of birth, spouse last name, spouse first name, date you contributed into the pension plan, started contributing to the pension plan, you are vested. All of your statements should say you are vested. Vested means you are entitled to receive pension. So once you make a single contribution into the plan, you become vested. That means you'll be entitled to receive a pension. Also, in section 1, there is a person ID number. Let me use a red dot here so it can be visible right here. Person ID number. This is a unique identifier that is assigned to each plan member. So you can use to identify yourself. For example, when you contact public service pension, or you call them, instead of giving your social insurance number, you can use that number. Or if you communicating by email, you can use your person ID number. Also, when you try to log into my account, it will ask you username. That can also be used as a username, but you can go change it. But that's your username. There is also an important note here in section 1 that says if you have a former spouse who had entitlement to share your pension or right to share your pension, there will be information here. Because what happened is, because pension is considered as a family asset, matrimonial property, former spouse could have entitlement to part of your pension based on, of course, separation agreement or a court order. So if that is the case, the pension statement or members benefit statement includes your former spouse share. That means when you actually retire, your pension benefit would be less than what is shown on this statement. That is section number 1. Section number 2. Section number 2 is your beneficiary information. So again, if you have a spouse, it's automatic. Your spouse is immediately your beneficiary. Whether your spouse is listed on your statement or not, they're immediately the beneficiary. And the definition of spouse is someone you are legally married to or living in a common law relationship for at least 2 years. That comes under the definition of spouse. So if you don't have a spouse, then you can name anybody to be your beneficiary. Again, you can sign into my account. There is a beneficiary section in my account. You can name multiple beneficiary. You can say, I want my 2 daughters and my son to be a beneficiary, or friend, family members, a society, a charity, organization. Or say, for example, you do have a spouse, but you wanted to name your son and your daughter as a beneficiary instead of your spouse. That's possible too. You can do that as long as the spouse agrees and sign a waiver. There is a spousal waiver form. It's called Form 4. Again, that form can be found or located in a website. The spouse must complete that waiver form and submit to the public service pension. Then you can name anybody as your beneficiary. Or let's say you are single, you don't have a spouse, you name your son and your daughter as a beneficiary. On your statement, it shows your son and your daughter as a beneficiary. Let's say after 4 years, that person got married. The new spouse become immediately the beneficiary. It's automatic. So if you want to keep your son and your daughter as a beneficiary, they have to sign a waiver. So this is if we die before we retire. The beneficiary is the one you have in your statement. When you retire, you have to complete a new form, giving the same person or a different person to be your beneficiary. Section 3. Section 3 shows your estimated pension benefits if you continue to work as you did in the past year and retire one of these dates. So here it shows earliest reduced 50 on 2039, 52, 60, 70, and then they calculate your lifetime pension and the bridge amount, assuming you continue to work at the same pace and at the same rate that you're currently working. Right? So what they do is, if you are, let's say you have 10 years of service today, you're planning to retire 20 years from now on, you're full-time, so the system will assume you are going to have 30 years of service after 20 years. The only problem will be the salary. The salary, they assume you continue to make the same salary you're making today into the future. But again, when you go online in my account, you can override, you can change that salary. If my salary goes up by 3%, 2%, you can use different assumption or different scenarios. And the bottom one here is your pension amount if you stopped working on March 31st, 2021. That is someone who stopped contributing into the pension plan and start collecting the pension when they are 50. That's why the amount, the monthly pension amount, the bottom one is lower than the top one, because the bottom one, it does not assume you continue to work. Again, if you log into my account, you can use different retirement date as well. Here, you'll see 3 or 4 retirement dates. But when you go online, you can do as many as you want. You can do your estimate month by month. The only thing is you can only save 10 calculations, but you can do it 20, 25. All right, that was section number 3. This is excellent planning tool, to see how much you expect to receive when you retire. And section number 4. Section number 4, it talks about the 2 elements they use to calculate your pension. In section 3, there is a pensionable earnings, which is your salary, and your pensionable service. And also there is another service in your account. It is called contributory service. So the pensionable service here for this person, the pensionable salary for fiscal year ending March 31st, 2021 is 41,151. Also shows the pensionable service for March 31st, 2021 is 11.96. Contributory service is 12. The reason why you might see a difference in the pensionable and contributory services because they have different meanings. Pensionable service means your actual time you worked while contributing to the plan. Your employer, they keep track of your hours of work from April 1st to March 31st, and then they convert into full-time equivalent, pensionable service. So you work full-time 12 months, you'll have 12 months of pensionable service. But if you work half-time, then you receive half of a month of pensionable service. So you work half-time for 20 years, you'll have 10 years of pensionable service. Pensionable service is the one they use to calculate in the pension formula. And the other service is your contributory service. Contributory service is not used to calculate or is not going into the pension formula per se to calculate your monthly pension. Contributory service is just a number of months you made contribution into the public service pension. So even if you are part-time, as long as you showed up to work at least 1 day a month, at least you make one contribution, you get 1 full month of contributory service. So someone works half-time for 12 months, contributory service will be 12. Another person working full-time for 12 months, contributory service will be 12. But pensionable service will be half, 6 months. So contributory service, let me put these 2 services into perspective by giving you an example of 2 people. 2 people working for 28 years. One works full-time 28 years, another one works half-time 28 years. After 28 years, they both will have 28 years of contributory service. Whereas pensionable service will be 14 years for the person who's been working half-time. So what is contributory service used for? Again, like I say, contributory service is used to determine if your pension will be reduced and by how much. For correction, if you retire at age 55 or older, and you have at least 2 years of contributory service, your pension will be unreduced, no reduction. That means it will remain the same. But if you retire before 55, between 50 and 54, to get unreduced pension, your age plus contributory service must add up to 85. So that is what contributory service used for. So you're not 55, you don't have 85, then reduction apply. This section shows your highest average salary as well. Again, actually, that was in section 3. Let me go back to section 3. they calculate here your highest average salary for March 31st, 2021 is $3,837. Okay, and sometimes we got a lot of phone call from members saying, why is my pensionable earnings in my members benefit statement in section 4 is lower than what is on my T4 slip? The reason, one of the reasons, a couple of reasons. One is because the pensionable earning on your statements is based on the fiscal year, your income from April 1st to March 31st, whereas your T4 is based on the calendar year, January to December. And the other reason would be because all earnings are not pensionable, as I said earlier, over time, or lump sum payout, bonus. They are not pensionable. Maybe that includes your T4, might include some bonus or lump sum payout. Section 5, the last section of your statements. This shows your contributions into the public service pension plan's interest. But remember, contributions are not used to calculate your pension. So contribution, your contribution, employer contribution, investment return, they fund the pension. So this is just for your information. It's also important to remember that your contribution do not reflect the value of your pension. Pension is based on your salary and service. So these are the 5 sections of your members benefit statement. So the one you just received in October, the next one comes sometime next week, next year. Again, you need to engage yourself to learn about, to update yourself. So one way to engage yourself would be to go to the public service websites. There is a My Account. There's a lot of information. There is a course you can take, e-learning courses. So the website is pspp.pensionsbc.ca. Also, there is also information specific to the correction employees about the plan change in that website. There's under plan change tab. You can register for webinars. Currently, we provide or deliver 2 online webinars. One is Approaching Retirement. It is geared for people within 5 years of retirement. And it goes about application process, options. The other one is Making the Most of Your Pension. It is an overview about the public service pension that is mainly geared for new folks coming into the workforce or people who are in their mid-careers. There are in the website, there is a learning guide, annual reports, and a lot of information. Again, I cannot emphasize how important it is to log into my account. If you've never been into an account, and if you've never been into my account, you have to register first. And registration is very, very simple. You just go to the icon in the website, My Account. It will take you to the signing sheet. Then there is at the bottom of that screen says, "Let's get you registered." You just click that one, and they will ask you for a piece of information, your person ID number, which you can find it in your statement. Section number 1, top right-hand corner, your last name, your date of birth, and the last 3 digits of your social insurance number. You just have to submit that information online. An email will be sent to you very shortly with temporary password. So you get your email, get your temporary password, your user ID is your person ID number. Then you log into my account. You can use personalized pension estimator and calculate your pension using, like I say, a different scenario. If I work part-time the next 5 years, or if my salary goes up, you can do a personalized purchase cost estimator. If you take a leave of absence, that will affect your service, but public service pension, they do have a provision that will allow you to buy back that service. And then you can do it yourself. It tells you how much it will cost you and how much it will impact your pension as well. You can look at your past members' benefit statements. Again, in the past, in the old days, members used to call us, and we used to, if they lose a statement, we used to print it and mail them. Now they can access it by logging into my account. You can look at the service and salary history online. Remember, everything we talked about is service and salary because your pension is based on service and salary. These two elements are the ones that get reported by your employer. So your job will be to make sure that has been reported correctly. If you have any question about your service, you need to contact your employer. It could be leave of absence, it could be strike time, job action. You can nominate a beneficiary. If you don't have a spouse, you can go on my account, the beneficiary tab, and nominate. You can name primary, you can name an alternate beneficiary as well. You can update your personal information, spouse information, address information, or if it's incorrect, you can update it yourself. Now, people can apply for pension online. It used to be paper only. Now they can choose options online. Benefit can be selected online. Documents can be uploaded online. There is also a message center in my account where you can securely send or receive message and communicate with the public service pension. And instead of using your personal email, you can do that through my account, and it's very secure. I always say this, especially if you are communicating confidential information or you're trying to upload confidential documents, I strongly encourage you or suggest you to do that through Message Center, as it is very secure. So, takeaways from today. The Public Service Pension Board of Trustees will use a part of the surplus to improve your pension, effective April 1st, 2022. Your bridge benefits and early retirement provision remain the same. And also, you will be refunded extra contribution made by the end of October 2022 because of the rate structure change. Again, action to take. Please make sure your employer and the plan have your correct mailing address on file. You can check and update your address in my account as well. You can update it. I think that is end of my presentation. And Nikki, back to you for any Q&A.
Okay. Thank you so much, Mogus. So before we start our Q&A, I do want to stress that point. To make sure that you get your refund check, please make sure that your address on file is correct. And you need to do that two places. Number one, with Pension Corporation, and you can do that through my account to make sure that your address is correct, but also check with your employer. They should be reaching out to you right now, actually, to make sure your addresses are correct. It had a T4 time. So now is a great time to make sure that both have your correct address, and that way you will get your refund check when it's ready. Okay. So we're going to start our Q&A time now. So again, please write your questions in the Q&A feature, and then I'll see them and I'll read them out to Mogus and to Doug. And we'll do our best to get to as many as we can. We have about an hour set aside, but we'll take as many as we can. And if we don't have any more, then we'll wrap up early and we can all go home. But let's do some questions. It's a good opportunity because we've got two experts here. So the first one that we have, Mogus, when I first started, I was unaware that you could buy back pensionable time due to being on a call board. I didn't find out this information until my 7th year, and then it was too late. Why is that? So why is there a 5-year window for purchasing service?
Well, yes, prior to 2002, it was open. You can buy anytime, any service. But the rules came that they put a window of 5-year window of opportunity. So you have to buy within 5 years. That was the plan rule that was introduced. That came in 2002, and by 2007, everybody must buy. So that my answer would be the plan rule at that time, the new plan rules.
Okay. All right. So then the second question that we have can I add a secondary person as a beneficiary to my pension? For example, when I die, my wife receives my full pension. When she dies, can my secondary beneficiary, such as my daughter, receive my pension? If so, will she continue to get the monthly benefit or will she receive a lump sum payment? And how is that calculated? So there's a few questions there. So I guess the first one is I'll read it again so everyone hears. Can I add a secondary person as a beneficiary to my pension? So for example, when I die, my wife receives my full pension. But when she dies, can a secondary beneficiary, such as a daughter, receive my pension? If so, will she continue to get the monthly benefit or would she receive a lump sum payment?
Okay, it depends when the member passed away. Is it before retirement or after retirement? So if it is before retirement, that means before selecting an option, if something happened to the plan member, and also depending on how old the member is when they die. If they die before reaching retirement age, before 50 for correction, they have a spouse, the spouse will get either immediate pension for life, or spouse can get what we call a commuted value. Right? If something happened to both, say, then a lump sum will go to the beneficiary. If something happened to both a member and spouse, let's say car accident, before they retire. But after retirement, it depends on which option they choose. You see, at retirement, retirees must select an option. There is an option, what we call single life option, or a joint life option. Single life, there are 3 single life options. Single life 5 years, 10 years, 15 years. That is an ideal option for someone who is single. If you have a spouse, you get additional option, which is called a joint life. The joint life option are expressed in terms of percentage, 100% or 60%. So to answer the question, if a person chooses single life 10 years, or let's say 15 years, they put their spouse as a beneficiary. They can name an alternate, secondary, anybody. They can say, I want my son and my daughter to be an alternate in case my primary beneficiary were to die before the guarantee time expires. Right? Say single life 15 years, spouse is primary, son and daughter is an alternate, spouse passed away in 6 years. There are 9 years remaining. The alternates become the beneficiary. Now, let's say the plan member passed away after after 11 years. Still, there are 4 years remaining. Now, the alternate will get a lump sum of that 4-year period. As far as the joint life is concerned, with the 100% joint life, what happened is, let's say you've been contributing into the public service pension. Say you contribute $100,000 over 25 years, and you retire. You selected 100% joint life. That means if you die, spouse gets the same pension for life. Let's say the pension is $2,000 a month, and both passed away in 5 months. That means they collected only $10,000, but they have contributed $100,000. Then there is a difference of $90,000. What you've contributed over 25 years versus how much you collect as a pension. Then it will go to the alternate, if there is any. But trust me, to consume what you've contributed into the public service pension, it takes about 2.5 years. So both must die within, very early or prematurely. With the joint life, 60% joint life is different. 60% joint life, you can attach a guarantee time. If you choose 60% joint life, 15 years, spouse must be the primary, you can name an alternate. Anybody again. 60% joint life, 15 years, spouse passed away before the guarantee time, the alternate become the beneficiary. Say spouse passed away in 6 years, member passed away another 11 years, 4 years remaining. So beneficiary cannot get the pension for life. They get a lump sum for the remainder of the guarantee time only. So depending on when they die, before or after retirement. I hope that will answer the question.
No, thank you, Mogus. And now I'm going to do a plug for another webinar that we have that every member should take. You can find it on the plan website under our learning resources section. There's a webinar called Approaching Retirement, and we recommend that for any member getting in within 5 years of retirement. And there you will learn all about these pension options, and you'll have lots of opportunities to ask questions at that time. And there's also, I believe you can also adjust your beneficiary information on my account. Can you not, Mogus?
Absolutely, you can. The
You
plan
can.
member can, yes.
The plan member can. Excellent. Good. So yeah, look at your beneficiary information on my account, and as soon as you start getting near retirement, take that webinar. You can take it either as a course or you can take it online with an instructor, and there's lots of opportunities to ask questions there. Great. Thanks, Mogus. So we have a third question now. Will the pension check, the refund check, will it be attached to a paycheck or will it be separate?
Would you like me to answer that, Nikki?
Sure. Thanks, Doug.
I'll do my best. Please correct me if I'm wrong, but my understanding is that that refund check will be mailed to you by the pension corporation. It will not be attached to your biweekly paycheck.
That is correct. Excellent. Now I'm going to look to see if we have any more questions. I don't see any coming in, so just I'll give a few moments to see if anybody is brave and wants to stick another question in our box there. But as I said, we do have that webinar Approaching Retirement, but we do have some other offerings for you. If you're new to the plan or relatively new to the plan, we do have an online course called Getting to Know Your Pension, which covers the really broad strokes, basic information about the pension plan. And that's an online course that you can take anytime. And then we have another one called Making the Most of Your Pension, which talks to you about, purchasing service and all the different things you can do to make sure that you're getting the best pension experience you can. That is also an online course, or you can take it as a webinar with an instructor, and that will give you the opportunity to ask questions. And you can register for both of those on the plan website. Just look for learning resources up at the top, and then look for online courses and webinars. And they're free and they're offered throughout the year, and they're a really great resource for members. So, okay. We do have another question. Okay, number 4. Will the refund check be taxable?
I can answer that, Nikki. The refunds are taxable. However, it is important to note high income earners may not have their refund taxed if they exceed taxation thresholds. But the recommendation is always to, for any tax information, there's information available on the Canada Revenue Agency website, or speak to a tax expert, an expert in that field.
Great. Thank you, Doug. And we have a 5th question. I'll direct this to Mogus, but feel free to jump in, Doug, if you want to contribute. Is the temporary market adjustment pensionable?
It is pensionable. Market adjustment is pensionable, yes.
Great. And just while we have a couple minutes here, let's see if we have another question. If you are looking for more information about these changes, you can go to the plan website, pspppensionsbc.ca. And if you look at the very top navigation, you'll see an area called Plan Changes. If you select that, you'll see an area for corrections employees, and that will do it'll take you to a little guide where it will walk you through all the different parts of the changes. And yeah, it's a really nice little resource. Everything is there, and please check it out. Oh, we do have another question. Excellent. I'm going to say, will the refund check be on our salary T4?
I can take a stab at this, but I want to be careful for the person asking the question. My understanding is that it will not be on your employer issued T4, but there may be a subsidiary tax document issued by the pension corporation on that. I think we can get that answer and post that online following this to be more specific.
Yes. Yeah, we'll take that away and we'll add that to that Q&A document that we're going to post to the website after. We just want to make sure that we're correct. So yeah, I'm going to write that down right now and make sure that that's added to the Q&A. Great, thank you. Okay, now here is a question that I'm sure Mogus has had a few times. Does a common law spouse have to lay claim to your pension or is it automatic?
Okay. Under the Family Law Act, FLA now, common law relationship is exactly the same as a married couple. So they have the same right as a married couple.
And when does the clock start, Mogus? So say I move in with a partner.
Yes, as far as pension is for pension purpose, it's 2 years. They have to live together in a marriage-like relationship for 2 years. Yeah.
Okay. And what proof do people need? I'm sure that's another question you get asked.
Yeah. Well, it's just they take their words. There's no proof to ask.
Okay. All right. So our first question pertains to, I believe, health and dental coverage. And Mogus, I'm going to direct this one to you. If you're residing in another country, are you still covered by health and dental coverage?
Okay, that's a good question. Like I say, the provider for group benefit is Green Shield Canada, and Green Shield Canada is national, so you'll be covered anywhere in Canada. But if you're planning to travel or to go out of country, it does not include out of country coverage. As a matter of fact, if you're going temporarily or for a short period of time, they suggest to buy a separate travel insurance. So it does not include. Thank you.
Do you know, Mogus, if they can get travel insurance through Green Shield Canada?
Well, good question again. Well, you know what? There is an association they can join after you retire. It's called the BCGRA, the BC Government Retiree Association. They can voluntarily join after retirement. They can get it through that or through Green Shield Canada as well. Yes.
Okay. Thanks very much. Our second question is how many minimum years of service are required before you can start your pension?
Minimum years of service. Like I explained earlier, the vesting requirement is now day one. So you can work 1 year, you can collect pension based on 1 year. So it could be small pension. As far as maximum is, there is 35 years maximum. So the maximum service is either 35 years or age 71. The end of November, you turn 71. Whichever comes first, contribution into the plan must start. So there is no minimum. Day one.
All right. So if somebody wanted to get their unreduced pension, is there a standard age for that?
Unreduced pension. Again, see, there is a huge misconception between unreduced pension and maximum pension. See, unreduced pension, it doesn't mean you get a maximum pension. So if you retire at 60 or older and you have at least 2 years of service, you get unreduced pension. That means your pension will be based on 2 years of service. It could be $75, but you get $75. It means remain the same, not reduced. But if you are under 60, so for correction will be 55. That's for regular members 60. Correction is 55 or older, and you have 2 years of service, you get unreduced pension. But if you are under 55, when you retire, your pension will be reduced further, unless your age plus service adds up to 85.
Okay. Thanks very much. Our third question, and I'll direct this to you again, Mogus.
Yeah.
I was off work with WorkSafe BC. Did I continue to contribute to my pension?
Okay, very good question again. WorkSafe BC, it's a little bit tricky, WorkSafe BC. If a member is receiving a WorkSafe BC benefit directly from WorkSafe BC, they are considered leave without pay. That means it will affect the pension. They consider, so they lose pensionable service. However, if WorkSafe BC pays the employer and the employer pays you, then your pension will not be impacted. So it depends how WorkSafe BC benefit was paid to member.
So our next question, we've got a couple of questions about this actually. Can you please explain the rule of 80 and how it is applied?
Okay, again, good question. Rule of 80 for correction, it does not apply. Rule of 80 applies for police personnel, firefighters, or other employment group. For correction, it's rule of 85. That means if you retire at 55 or older, you have at least 2 years of service, you get unreduced pension, meaning you don't need to worry about rule of 85. Rule of 85 does not apply if you retire at 55 or older. Rule of 85 applies if you retire between 50 and 54. If you retire before 55, your pension will be reduced. Why? You're going to collect a pension for a long period of time than someone who waited until 55. So unless your age plus service equals 85, that means if you retire at 50, you need to have 35 years. If you retire at 52, you need to have 33 years so that it adds up to 85. Right. That is rule of 85 apply. That means rule of 85 applies in two conditions. One, you have to be under 55. Second, if you're 55 or older, you don't need to worry. Rule of 85 doesn't mean anything. By the way, when they calculate the rule of 85 to see age plus service adds up 85, they use contributory service. Okay. That is when the contributory service comes to play.
And people can do pension estimates in my account. I think they can do up to 10 different estimates to see how they may be impacted by different retirement ages, correct?
Well, they do actually as much as they want. They can do 20, but they can only save up to 10.
Okay.
So yeah, they can save up to 10, but they can do different calculation.
So you can see your different retirement ages and how you're impacted by using the calculator in my account. So please check it out.
Yes.
So we're going to move on to our next question. And I'll direct this to Mogus, but Doug can weigh in if he wishes. Why was the accrual rate raised to only 2.25% and not to 2.33 per the public safety occupation sections as listed in the CRA?
Okay, well, I believe, like I say, that is at the discretion of the board member, also based on the valuation of the plan. But I guess Dag maybe can talk more about this.
Yeah, thank you, Mogus. I'm happy to weigh in. You're absolutely right. I can't discuss the specific details of the debate and considerations that went on at the board level, but essentially the board is given a surplus number, and then they have to look at a number of areas where they can utilize that surplus funding. So the money that was used, the surplus that was used to improve the benefit for corrections, the decision was made that it was 2.25% going forward, in addition to the other changes and improvements that the board made with the surplus to other areas.
Okay, thanks very much. And just a reminder to everybody, at the end of this webinar series, we're doing a session today and we're doing a session on Thursday evening. We'll put together a Q&A document and post it to the plan website so you can revisit all the answers to the questions that are answered today. So we have another question here. Minimum years before I opt out for permission. Suppose I work for 5 years, can I go for permission? Maybe you mean pension, go for pension? Minimum years before I can opt out for pension. So I guess, Mogus, could we say, is there a minimum number of years that somebody has to work before they're allowed to go on pension?
No, like I say, it used to be all days vesting requirement used to be 10 years and then reduced to 5 years, then 2 years, now is day one. So you make one contribution, you are entitled to receive a pension. So really there is no minimum, but your pension will be based on years of service you have and your highest average salary.
So the longer you work, the more you get.
The higher your pension will be. Absolutely.
Okay. All right. Are there any more questions from anyone attending today? I think that's all we've had submitted. Oh, here's one. Oh, good. Okay. Okay, Mogus, please correct me if I'm wrong. If I am 20 and work 30 years, I will have a reduced pension. If I am 25 and worked 30 years, I won't have a reduced pension. Why?
So if you are 20, you work for 30 years, that means when you retire, you will be 50 years of age. That means you are under 55, 20 plus 30. And you are 50, you have 30 years, it does not add up to 85. So that means, remember I said if you are under 55, to get unreduced pension, your age plus service must add up to 85. But if you are 25 years of age and you work for 30 years, when you retire, you are 55. Really, there is no reduction. Or you have 85. Even if you don't have 85, once you reach 55, there is no reduction. You get unreduced pension. Like I said earlier, there's huge misconception between unreduced pension and maximum pension. Unreduced pension, it doesn't give you maximum pension. Right? Your maximum is your maximum based on how many years of service you have. As I said, if a correction officer retire at 56, they have only worked for 5 years, they get unreduced pension. But it doesn't mean they get a maximum pension. It could be $200 a month. So please, unreduced is completely different as maximum pension. Actually, reduced pension, I don't look at that as a penalty. The way I look at reduced pension is an incentive to retire early so that you can collect pension for a long period of time. It's like Canada pension, government. If you take it before 65, there is reduction. Why? Because you're going to collect it for a long period of time than someone who waited until 65. So.
Okay, so the more you work, the more you get. Really, that's the big message, especially once your rate goes up, your accrual rate goes up. Mogus mentioned that we do have other webinars that you can attend to. If you go to the public service webpage, you'll see a section called online learning or learning resources, and then you can go to online learning. We've got a special getting to know your pension online course that you can just take at your convenience. We also have a video about understanding retirement health coverage that you can watch, but we also have 2 other webinar series that you can either watch as an online course, or you can sign up to have a live instructor lead you through them. The first is making the most of your pension, and then the second is approaching retirement, and that's really good for members who are within 5 years of retirement. So if you liked a session like this, please check out that page. It's on the Public Services webpage under Learning Resources, Online Courses, and Webinars. Okay, we have another question here. What is the earliest time that a member needs to apply to cover the spouse? So if you as a member die after you retire, how do you protect your spouse? How do you go about that?
Okay. Again, as I mentioned at the beginning of my presentation, your pension is something that provides you a secure lifetime income. For you as a plan member, you get a pension until you die. And also, if you choose benefits, a group benefit will continue until member die. Also, pension can provide financial care to the surviving spouse or beneficiary in case a member died first. So at retirement, depending on which option you choose, so you will be provided with different options, pension option, and you have to select one. So selecting an option is similar to buying a life insurance. You want to protect the other person. There is an option, if you look at on your statement, members benefit statement on section 3, there is a pension calculations, and there are 2 options, single life 10 years and 100% joint life. This is an option you have to choose. If you have a spouse, you have to select between single and joint. If you choose single life, the spouse must sign a waiver. So, or you can choose joint life. The option depends on if the spouse needs your pension after you die. So joint life, you choose joint life, you die, after you retire, spouse will continue to get the pension for life. Benefits also continue for life. But if you choose single life, guaranteed 5 years, 10 years, or 15 years, a member passed away before the guarantee period expire, the spouse get the pension only for the remainder of the guarantee time. Benefit also continue only for the remainder of the guarantee time, and everything will stop. That's why I said selecting an option is protecting the people you care about, the loved one, the people you're leaving behind.
And while we're talking about that, could you just briefly explain what the joint life option is? Because that will carry on for your spouse's remainder of their life, correct?
Correct. That means if you die first, spouse will continue to get the same pension until he or she dies for the rest of their life. But there is a cost. Right? If you choose single life, you choose single life. But by the way, for a plan member, whether they select single or joint, they get it for life. Right? If you choose single life 5 years as a plan member, you live 100 years, you collect the pension for 100 years. Option is if you die prematurely, if you die early, you wanted your lifetime pension to continue to the loved one. So with 100% joint life, you're protecting your spouse for the rest of their life. And the cost will be, your pension will be lower than the single life. How much the lifetime pension will go down depends on the age of your spouse. Meaning, the younger the spouse, the more it will cost you. And vice versa. Because if you have a younger spouse, you die first, the younger spouse will collect a pension for a long period of time. It will cost you more. So if you marry someone else older than you, that is a good financial.
So Mogus, does this all the pension options, single life, joint life, are these covered in the Approaching Retirement webinar?
Absolutely. I strongly encourage you, if you are within 5 years of retirement, try to register for Approaching Retirement webinar. It is available online. It will cover about options. Also, they talk about key factors you need to consider before you select, or helps you to choose the right option as well. Yes.
Wonderful. Thank you. Okay, we have another question here. Does a reduced pension ever become unreduced while you're collecting your pension?
Okay, a good question again. Remember, once your pension is reduced, it will remain reduced for life. No, it doesn't go up. It's like same as federal government, Canada pension. If it's reduced for life. Public service pension, if you retire before 55, you don't have 85, it will be reduced, and that reduction is for life.
Okay, thank you. So here's a question. Mogus, I'll direct it to you, but Doug, weigh in if you like. Please explain which number we can use to calculate an estimate as to what our refund will be, the refund that we'll receive by the end of October 2022. So if I wanted to know, for example, Mogus, what my refund is going to be, is there a way I can find out before I get my check?
The refund amount would be based on your income. How much you made between August 1st, 2018 until March 31st of 2022. 0.35% of your earnings. It's not to do with the number. It's based on your earning and the percentage of that earning, 0.35%. You want to add on it, Doug?
That's exactly right, Mogus, in terms of the math. I would only add, I just made a note, I would add a caution to folks that are attempting to do any kind of estimates on their own. My advice would be that these are very individualized numbers. And down the road, not today, I would contact PenCorp. I've put in my notes sometime after May 1st of 2022. Those calculations will be closer to complete. And again, I would urge patience, as those numbers take time to calculate into proof before the refund checks are issued. But in terms of the math, it is exactly that, 0.35% of salary for the period in question. But again, just that extra bit of caution.
Yes, we have something at Pension Corporation called year end, when all the employers get all of their information in, and then our staff have to go through all of those records to ensure that everything is calculated correctly. So I would not try to get an estimate just yet, but you will get something, and yeah, please take Doug's advice to heart. So thank you. Okay, we've got another question here. I am entering my 34th year of service. At one point, we had the rule of 80 for retirement. When did it change to 85, and was it announced to members? So I'll open this to both Doug and to Mogus to see if they know.
Well, for correction, always known, it's 85. But 80 was for police person and firefighters and certain ambulance workers. So I think it's, do not recall, the rule of 80. It's been rule of 85. But the earliest retirement age was 50.
Do you have any comments on that, Doug?
I don't have anything to add.
Okay. I will, outside of this webinar, go back to our policy group and see if there was ever a time that it was rule of 80 for corrections. I don't believe it was, but I will find out and make sure that gets added to the Q&A that will go on the website shortly, okay? Thanks very much. Do we have any other questions to come in today? Oh, okay. There's a question. Are people mixing up the rule of 80 and 85 with this year 60 and year 55 reduction? Possibly. So Mogus, could I get you just to summarize what is the earliest retirement age for corrections? So unreduced and reduced. And could you just speak to the rule of 85 just one more time for us, please?
Right, yeah. So rule of 85 for correction, if you retire, the earliest retirement is 50. Unreduced pension, as long as you have at least 2 years of service, is 55. So if you retire before 55, between 50 and 54, your pension will be reduced unless your age plus contributory service equals to 85. The 60 applies for civilian public service employee who are not correction. Then if they are under 60, reduction apply unless they have 85. So 80 applies completely for a different group of employees.
Okay, thanks very much. Okay, we've got a couple more questions coming in. Thank you. Mogus, if I receive early CPP, Canada Pension Plan, do I still get the bridge?
Yeah, okay, Canada Pension is a federal program. The bridge is a provincial. So really they are not financially connected. That means you can collect a bridge starting as early as age 50, get it until 65. Canada Pension, you can apply at 60, you can get it for life. So really between 60 and 65, you can get both bridge and CPP. So they are not connected.
Thank you. See, I think we might have one more question coming in. If you don't take the annuity top up, why does the pension go down at age 65? Is that because you get CPP?
Yeah, if you retire before 65, you get a bridge and a lifetime pension. You can buy a third pension, which is called temporary annuity, if you wish. So if you turn 65, if you don't buy the temporary annuity, the bridge will stop. Then that's why your lifetime pension will go down because, well, remain the same, but there is no bridge amount. So if you look at your pension before 65, that includes a bridge. After 65, the bridge will stop. But like you said, Nikki, they can apply also for CPP as well, right?
Okay. So with that, thank you so much, Moges, for leading us through this presentation. And thank you, Doug, for making time for us today and giving us an explanation of the changes from the board's perspective. So with that, we're going to wrap up our webinar today. We are so happy so many of you were able to join us, and thank you for taking time to participate and for all of your thoughtful comments and questions. And just once again, if you are finding a session like this valuable, please do register for one of our 2 webinars, Approaching Retirement, if you're within about 5 years of retirement, or Getting to Know Your Pension. And there's also learning articles on our website. There's lots of information on our website. So please check it out. Thanks again, and have a wonderful day.